Rate cuts trigger inflation, stocks, gold, and crypto. Melt-up central banks, particularly the US Federal Reserve, play a critical role in managing economic stability. One of their most powerful tools is interest rate policy. When rates are cut, borrowing becomes cheaper, businesses can invest more, and consumers often spend more freely. While this can stimulate growth in the short term, it can also trigger inflationary pressures. The ripple effect extends far beyond government policy, shaping the performance of major asset classes like stocks, gold, and cryptocurrencies. How rate cuts impact inflation. When interest rates are reduced, credit flows more easily through the economy. Mortgages, auto loans, and credit cards all become cheaper, and businesses expand operations through affordable financing. While this encourages spending and economic activity, it also fuels demand. If supply cannot keep up, prices rise, creating inflation. Investors closely monitor this cycle because inflation directly affects purchasing power, corporate profits, and overall market stability. Rate cuts can feel like an economic stimulus, but they often carry the hidden cost of higher inflation down the road. Stocks, fuel for a market rally. Historically, stocks benefit in the short run from rate cuts. Lower borrowing costs make it easier for companies to finance projects, buy back shares, and grow earnings. Consumers also spend more, boosting corporate revenues. Technology, consumer discretionary, and growth-oriented companies often outperform during these periods. However, the picture isn't always rosy. If inflation accelerates too quickly, the costs of goods, wages, and raw materials rise, which can pressure profit margins. In addition, persistent inflation may force central banks to eventually raise rates again, creating volatility. For investors, this means stock markets can experience a melt-up, a sharp, unsustainable surge, followed by potential corrections. Gold, the inflation hedge. Unlike stocks, gold thrives during inflationary environments. Investors have long considered gold a safe haven asset, especially when paper currencies lose value. Rate cuts weaken the US dollar because lower interest rates make dollar-denominated assets less attractive. A weaker dollar typically boosts gold prices. When inflation rises, real returns on savings and bonds diminish, pushing investors toward assets like gold that hold intrinsic value. Historically, periods of aggressive rate cuts have coincided with rallies in precious metals. For long-term savers concerned about purchasing power, gold remains one of the most reliable hedges. Cryptocurrencies. The New Age hedge cryptocurrencies, particularly Bitcoin, have increasingly been compared to gold as a hedge against inflation. Rate cuts and money printing often drive interest in digital assets, as investors view them as alternatives to fiat currencies. Bitcoin, with its fixed supply of 21 million coins, is often described as digital gold. When traditional markets expect higher inflation, capital often flows into cryptocurrencies, creating sharp price rallies. Unlike gold, however, crypto assets are far more volatile. A rate cut-driven melt-up in crypto prices can create extraordinary gains, but also carries the risk of equally dramatic corrections. The melt-up phenomenon. A melt-up refers to a rapid, often emotionally driven surge in asset prices. It occurs when investors rush into markets out of fear of missing out, FOMO, rather than careful analysis. Rate cuts, combined with inflation expectations, create the perfect storm for melt-ups in stocks, gold, and crypto. For example, investors may buy stocks expecting higher corporate earnings, gold as a hedge against inflation, and Bitcoin as an alternative store of value, all at the same time. This synchronized rush into multiple asset classes can create bubbles, which eventually correct when fundamentals reassert.